Good morning. Welcome to the Monday Market Update. I'm Nash Paradise, joined with me, as usual, Mr. Andrew Cady down in sunny Florida. How you doing this morning, sir?
Doing good. How you doing?
No complaint. I mean, I got a bunch, but rather than complain, we've got a Monday Market Update after our first FOMC meeting with Warsh, having a new head of the Fed. So we got a little bit to talk about on that. We've got a bunch of stuff going on with the war, which we all said this is the most important thing. This is the only thing until no
It's
one
not.
cares anymore. Yeah. So there's a lot to unpack here. Let's jump right into it and start doing this unpacking. So, we see a little wiggle, we see a big jump, we see a little drop ski. What happened last week?
The Fed didn't like Warsh's speech. I don't know whether it was a mix of Fed Warsh's speech or, probably a mix of that and the dot plot showing, a very strong probability of a Fed rate hike rather than holding steady for the future. But, I think markets went in with high hopes and didn't really get out of it what they were hoping.
Yeah, it makes me feel like the markets are dumb. Like, this was telegraphed, clearly telegraphed. Warsh made it clear he was going to be pulling any kind of, future forecasting and considerations for where the Fed is going. Like, done. He's made it. He didn't put his dot in there. The dots are written in pencil, and they're higher. Like, we knew they were going to be higher. And the market's like, oh man, I had no idea this was coming. I thought everything was great. And, inflation was like, come on, man. Like, how are you surprised by this?
It's like the markets have not cared about anything other than conflict in oil. And now that conflict in oil are no longer the culprit, they decide to care about everything else.
Yeah, I feel like maybe we need promotions to like billion-dollar bond traders, and maybe we need to be the ones moving the needle here, because I will say Warsh did well. I liked him. I thought he was very smooth in his presentation. He didn't give a lot of information, but he answered the same question like 13 times, which I'm not sure I would have had the patience for. But it wasn't a bad presser. And, my biggest takeaway is the Fed is going to see what happens, make decisions when they come up, and, utilize outside resources for intel and make sure that, they're getting their information as, cleanly as possible and decide where to take action. But it feels like a pretty good takeaway from, our first Fed presser.
Yeah. And I do think, Fed Warsh is going to kind of redo the metrics that the Fed relies on. This whole idea of, 2% inflation, it's probably a bit of an outdated notion. And I think, Warsh is going to start to move away from that. I think it was a lot of things that should have been good.
Yeah.
But I think maybe with the conflict, no longer taking center stage is the way to say that. The conflict's no longer taking center stage. There's maybe a bit of a realization that the Fed is in a bit of a pickle and there are no rate cuts on the horizon. It's got to be a rate hike to really get us back to where we need to be, which it's not ideal for traders, and they did not react accordingly.
Nah, that target Fed target inflation under Powell was 2%, and with Warsh it was, well, I just care if it starts with a two. So now markets have interpreted that as inflation target at 2.99, which is very literal of them, and I think they're right. I think that's a reasonable target. I think it's more in line with what we're looking for. So rates get better, and then worse speaks, they get worse, and then we get hey, resolution of conflict. We're going to agree to a peace deal, and things get a little bit better quickly. But let's talk about on our next slide here what we had. Like, how do we break this down? There wasn't a lot of econ data last week. Nothing that was really relevant other than I feel like retail sales have jumped up significantly. It was a lot of discussion in Warsh's presser about retail sales, and those being a precursor to a lot of our inflation metrics that we're going to be looking at. Retail sales were strong. Like, do we care that they came in that high from the previous and the consensus reports?
I think we only really care if we also didn't see the consumer debt load increasing at a similar pace. It's apparent that U.S. consumers still have blinders on and are totally okay with Affirm and Klarna and 29% interest credit cards racking up debt on, buying things they don't need to impress people they don't care about.
Yeah, thanks, Fight Club. So where that's from. So yeah, last week I feel like we've done a good job summarizing what last week was. Sales are high, spending is high. It's going to bleed into inflation, but consumer debt also very high, and ultimately, Fed Warsh gets three-quarters of a thumbs up from me. I feel like I like his direction here going forward. We'll see where that goes. Let's talk about what's going on this week, though, because this week is much heavier. We were kind of saying last week was a light week, had a holiday, had the presser, but boy, look at Thursday. Thursday, we got a lot of inflation coming in. PCE, jobless claims, durable goods, core CapEx, and speeches from four members of the Fed. Thursday's loaded. What are you thinking?
And we got personal spending. We got, yeah, Thursday is going to be the day that buckle your seatbelts, boys and girls. The market's going to move. I mean, there's just at this point with a peace deal inked with oil. I mean, what was it, 76 this morning? I mean, we're $10, $8 off of pre-conflict prices. That is no longer going to be the driving factor. We're back to this stuff actually moving the needle and moving the needle in a meaningful way.
You got to hope. And with oil coming down, what we've been saying for weeks and weeks and weeks, well, once oil comes back down, the 10-year bond will follow, and it did until it didn't. And now it's going the opposite direction. 10-year yields hover around 4.5%. Not a good spot. We don't want this 4.5. 4.5 is going to lead to 6.6 interest rates, and like it's not where we want to be. Thankfully, there is so much data coming out Thursday that I'm actually kind of hoping and projecting a bit of a mixed bag. With jobless claims, continued claims, plus the PCE, which is anticipated to go up. I feel like the year-over-year PCE having a target of 4%. It's not going to sound good when headlines come out. Oh yeah, PCE, inflation is up over 4%. You also got the PCE prices; those are already projected in the mid fours. But we may be able to get some balance here with things like the CapEx or with corporate profits in Q1. The previous quarterly on corporate profits was 5.7%. The projection now is a negative 0.4%. That could be good, or we could miss, and we could miss badly, and we could see that up a lot. Hard to say. And then thankfully, we're just going to hear from four members of the FOMC and figure out what they think about everything. But man, really hard to throw any darts on Thursday with all this data. I'm not sure that you can do much more than hold on.
Yeah, and I think the markets, there's not a lot of data coming out prior to Thursday. And we're in this trading range on the 10-year treasury from like a 451 down to a 443. 451 needs to hold. But I think we're probably towards the top end of it. In a lack of news, we could see that trickle down to the 443 range, and then Thursday either make a breakout potentially below it if we get a mixed bag of goods towards the right direction, or we could see a breakout above it and really see ourselves back up to that 460 on the 10-year treasury. And it's going to be data driven this week. Wars, I mean, obviously one tweet away from going back to war, everything could change in a heartbeat. But it is, what's concerning to me is this peace deal. It seems fragile. It seems like there's still a lot of crap talking, watching my language here, a lot of crap talking between the two sides. And I would feel a lot better if we had an inked peace deal and the 10-year treasury dropped down to 430, 433. Because if the peace deal falls apart, okay, we spike back up to 450. But with a peace deal inked and us sitting at 450, it sure feels like one bad move on that peace deal could send us to 460, 470 really, really quickly. It's like we got the peace deal signed and we didn't get the betterment because of it. Now, if that peace deal unravels, I feel like we're going to see worsening it's beyond what it was.
Yeah, I agree with you completely. We didn't see the improvement, but we could see it go in the wrong direction. This is like being on the playground in third grade and you got two kids who've been messing with each other, agreeing, shaking hands, and yeah, we're going to make nice. But then someone's little brother is over here throwing dirt claws at the other kid. And that's, Israel picking on Lebanon right now and, missiles going back and forth like, yo, bro, chill. Trying not to get grounded here. Like, come on, man. Like, let's get a little chill ski. But it unfortunately highlights the lack of leverage that the U.S. has. Like, we can't get Israel not to bomb Lebanon. And, Iran has got that in their back pocket as a way to say, nah, fam, we're going to keep the straight going. Like, we're losing leverage quickly. And that's been highlighted recently. And it's a bad look. It's not good. And it's, no one wants, at a certain point, like, this is a very unpopular conflict right now. No one wants it to continue because it's hurting everyone here. And the problem is, as we get weaker and weaker in our positioning, if Iran starts to bow up a little bit, that will change the opinion of a lot of Americans on whether or not they're cool with this peace deal. I think right now, no one paid a whole lot of attention to all the details of it. There's, the fringes who really focus in and dial in and learn that stuff. But, it could make that shakier. And to your point, we didn't get as good as we should have gotten with it, being put together. But if it falls apart, it's getting a lot worse.
Agreed.
Let's see. We got a comment here. Do you think the market is reacting on the peace deal falling apart instead of taking, I feel like the market feels like it's shaky. European bonds got hammered on Friday, but they have since recovered. Oil had been the primary catalyst for bond movement, but now the 10-year and oil have detached from each other pretty significantly. Sure. I've been plugged into, group chats of people smarter than me all morning, just trying to figure out, like, how do you explain a 450 10-year when, given everything that's happened over the weekend, we should just be so much better. So, we could be green by the end of the day. Who knows? This could turn around pretty quickly. Hard to say exactly, but what we do know is the markets are confused. They don't like a lot. There's a lack of trust in things getting done, but it could always get worse. So, hey, there's that too. All right, let's move on and talk about getting worse. Here's what worse looks like. Based on the dot plot, this has moved a lot. And right now we are strong forecasting a rate hike by the September meeting, but we could even have a rate hike by July. And that wouldn't surprise me depending on what happens and how, the next few sets of data looks like. But like, even then, that's not a long spot to sit in. That we've got another projected hike by the end of the year. 2 hikes by the end of the year really seems to be bothering the markets right now.
Correct.
Yeah, it's just not a good situation. Ooh, what do we got here? All right. This is depressing too. Thanks, kid.
Thanks, guys.
Like,
appreciate you giving us all the fun slides today.
Yeah.
I mean, I'll say this. I mean, hey, this is the first time we've had the third column of a potential third rate hike with any percentage in it.
Yeah. I mean, but at least it's a low percent, right?
I mean, 6.34%. I mean, yeah, it's low. I don't think we go to a third rate hike. I'll just say it. I think in the next 1 to 2 meetings, we get a rate hike. I think we let the markets calm down for a couple of rate meetings. we see what happens, and potentially a second rate hike. I would tend to agree December, January, March meeting if the market warrants it. But that is a long ways in the future, and a lot of things can happen between now and December.
Yeah. 3 months ago, we looked nothing like this. 6 months ago, we definitely didn't look anything like this. We were still projecting cuts at this point. So it just goes to show how quickly these things can change and how, the future forecasting, it paints a picture, it tells a story. But what this story is really saying is we think we need to go up for a little bit and then we can settle back down. Is that two hikes? Everyone seems to agree on their dot plots that it's probably two hikes. And what is it going to take to get inflation down into the twos? Well, we're going to know more this week as we see where is the PCE right now. And it's going to take a few more sets of data before we feel confident. But I do know that Warsh and a lot of the members of the Fed do not want to be slow to increase like the last Fed was, coming out of 2021 when, inflation started going nuts and they were just really behind the eight ball on getting the Fed funds rate pumped up. That set us up for a lot of bad things. So it better to increase quickly and be on top of it if we have any chance of getting inflation down into a number that starts with a two. They're going to have to take action. Second part of this chart here, hovering around that 6.6 range. We've been here for a bit. I think 2 months, 3 months. It's been worse, but it's 658 right now on the overnight average. Anytime we are comfortably over that mid 6 point, which we have been for a while, the markets seem to behave one way. As we get under 6.5 and maybe trending in that direction, markets have a little bit more excitement. People are feeling a little bit better about 6.375, 6.4 interest rate than they are at 6.6. But we're still seeing housing starts. We're still seeing new applications. Not seeing refinances really, but we're still seeing things move.
Yeah, I'm still having a great year. Like at the end of the day, I don't say there's no business out there because the business is popping. Nash and I are in a competition to see who can close more loans right now. I think you're at 51 closed, and I'm at 49.
Are we in a competition? You didn't tell me about this.
No, I'm at 49. You're at 50 for the year. Like, guys, at the end of the day, there's business happening. People are buying. It's the mentality we have. Speaking to the loan originators on this, it's the mentality we have going into this. If we're negative, we're going to attract negative people. We're going to attract negative attitudes. We're not going to find the business. At the end of the day, I'm going to get the business that's mine, because I'm going to be out there and I'm going to be seen as a advisor in this business, regardless of what the markets do. I can't control the markets, but I can control me.
Yeah, there's plenty of opportunity. I'm growing. Andrew's growing. You do the right things. There's less market share, but there's enough market share. There's definitely enough for professionals doing the right thing, making the calls. It's tricky because there's less per capita. Realtors are doing less business on average across a wider scale. Loan originators are going to need more partners, do more of the right things. But we're in a great position because we sit in an office, behind a desk, next to a cell phone that can be used to contact ever so many people on a weekly basis. And, it may take more partners, it may take more phone calls, it may take being different than your competition. And that's fine because the opportunity is there. And we're seeing a lot of people grow in a down market, in a, year full of conflict and difficulty, but the business is there for the people that are willing to work for it. So
Agreed.
as far as lock or float, and this is definitely a don't mess with Texas kind of week. Like things can get rough and they could get out of hand. There's no way to know where things are going. I wouldn't be surprised if we got to the end of the week and things were a lot better. Like it can happen. There's enough in there for it, but there's definitely not enough to forecast to be confident in that. So if you've got it, sell it, lock it, move on, go get another one. Otherwise, we'll be back next week, talk about what happened in our Super Thursday full of data. And, hopefully we start moving back to a more data-dependent world.
Appreciate you guys. Have a good day.
Y'all take care.